Hello, everyone, and thanks so much for joining us today. My name is Steve Arnott. I'm part of the customer success team here at Snap Projections, and I'm excited to go through today's half-hour webinar presentation. It will be a live product walkthrough and a Q&A session. Please feel free to participate throughout today's session by submitting your questions. You can do that in the GoToWebinar portal. So if you open up your portal, go to the question mark, and then submit any questions, I'll be able to see that throughout today's session and address those live. I'll also be going through a pre-developed plan in order to create a projection for a couple who is nearing retirement. And we're going to address three of the most common questions that clients may come to you with. The first one is, how long will my money last? Or in other words, am I going to be okay? The second is, how much can I spend so I won't run out of money? And the third is, how much will be left for my children or other beneficiaries? During today's session, we will be recording and sending out a recording after the session is done. So please feel free if you have to step away for any reason, or if you want to revisit any of the information shared today, that will be available. And again, we'll have some dedicated time at the end for questions, but if anything does come to mind throughout, please feel free to submit those at your pleasure. Awesome, let's jump into the software. So I've already signed into my Snap Projections account. You can see here I have all of the projections that I've created previously for various clients. If I wanted, I could click on the client's name, access those plans, make alternate scenarios, access the client report, or update any of the values if a client has changed their circumstances. In this case, we're going to be creating a new projection. So I'll click on Add New Client, and we'll enter in information for John and Jane Snapper, both born 1965. I'll add Jane. Perfect. So we've input our client details here within the scenario setup flow. So we have our scenario setup where we'll input all of the plan data. Once we're done with that, we'll go to the planning pages and review it in order to see whether there's any additional values we want to input, any changes we want to make for an individual year or for any period throughout the projection. And then we'll have the client report where we'll be able to go in, customize the pages included, and then generate a client-facing PDF document. For now, we'll continue on through the scenario setup. So I'll click on Next to go to the General Settings page. Here, I would recommend this far into the year, we'll likely want to start the projection as of 2024. This way, any balances that we enter, any debt values that we apply in the plan, those will be assumed to be the starting balance as of January 1st, 2024. So this is much more common as you get to the end of any calendar year. We can start the plan fresh as of January 1st the following year. We're going to assume a retirement age of 65 for both John and Jane, and we'll run the projection until age 100. As I scroll down, we have our general inflation rates pre-filled from our default settings, and then we've adjusted the FP Canada defaults to reduce them for expected management and expense ratios. So we have 1%, 2%, and 5% respectively for cash, fixed income, and equity. I'll click Next and go to the expenses page. Now today I'm going to be leaving this blank to start with. We're going to wait until we get to the planning page and get a bit more information about the client's circumstances before we set a target retirement spending goal. So we'll leave the base expenses blank. That just means that during retirement, we're not going to have any specific goal set up in the plan to start with. And then for additional expenses, we won't itemize anything out just yet. We'll wait until we're done on the planning page. I'll click Next and we can start to input the client's employment information. So we have $110,000 of salary for John. I'm going to assume that that will index over time at the general inflation rate. So I'm just going to delete the percentage that's pre-filled there of 0. I could also change the percentage if I wanted to. But again, in this case, I'm going to delete what's in the field, and that's going to automatically link it to the general inflation rate that we just confirmed at 2.1% on this page. It's going to be input as employment income, so Snap is going to automatically deduct CPP and EI. It's going to be taxed appropriately. It'll track and earn additional RSP room, and it'll run that income from the first year of the plan until the last year before retirement. If your client is retiring partway through the year, you can prorate the income for the final year of the plan. We could stop it, for instance, as of June 30th if they're going to work for half of the year, and Snap would automatically prorate that income on the planning page. At the top left, I can click on Jane's name in order to go to her salary information. Here we have 120,000 of salary. Similarly, we're going to delete the indexing value in order to assume that it just increases throughout the plan at the general inflation rate. We'll enter that as employment income, have that as taxed, earning RSP room, and running from the first year until the last year before retirement. Now we could add a defined benefit pension plan, but in this case, neither John nor Jane have one to include in the plan. So I'll click next and go to the assets page. By default, there's a non-registered account added to the projection just to serve as a location that Snap can allocate future surpluses to. In this case, we'll be entering in existing accounts. So I'm just going to delete that from the projection. I'll do the same by clicking on John's name and deleting his. And now we can input their existing capital assets. So they have a non-registered account currently with 150,000. That has a cost base of 120,000 and currently owned jointly. It's invested as 30% fixed income and 70% equity. So here our default rate of return values are being pre-filled from our general settings page, and our total portfolio return is being calculated based off of our asset allocation of 30% and 70%. I'll click next and input John's tax-free savings. Again, I know that I'm inputting John's because I can see that this cell is dark blue, and because we can see John's name next to the asset title. So we'll input a TFSA of 90,000. And that's invested more in a balanced portfolio of 40% fixed income, 60% equity. He also has an RSP of 120,000 and a defined contribution pension plan currently with 110,000. Across the top of the accounts, we can use any of the registered account tabs to adjust the settings within the plan for those accounts. So here we'll start with the 2024 contribution room. So the software has not yet been updated for the new contribution room. That'll be done over the new year break. So first thing in 2024, we'll have all of those values for tax rates, contribution rooms, and so forth updated. For now, you can just adjust the contribution room from the TFSA tab. I'll click on the RSP/RIF and we can update this based off of the client's most recent notice of assessment. So John has an existing contribution room carrying forward to next year of 50,000. For the defined contribution pension plan, we can set the jurisdiction. So in this case, we'll set that as Ontario. And then we can also unlock a portion of it depending on the jurisdiction into an RSP account. So I'll input all of that information here. Then the last thing is we'll input the employer and employee contributions that are currently being made into that defined contribution pension plan. So him and his employer are contributing 5% per year of the employment income. Now we can go back, take a look at the assets, and then click on Jane's name in order to input her information. We have a tax-free savings account of 110,000. Invested as 20% fixed income and 80% equity. We have an RSP of 225,000. Now, we can once again go through the tabs across the top. So we'll update the contribution room for 2024 to 7,000. For RSP and RIF, we can input the existing contribution room available. And then there's no DCPP or work pension in Jane's case. Coming back to the list of assets, we can scroll down to the bottom to the real asset section and input their home. So this is where we could enter any real asset transactions that the client has. So things like an investment property, buying a cottage, or modeling the sale of corporate shares, for instance, can sometimes be done as a real asset. And you do have the ability to model future purchase age if the client is saving up for a property, or a future sale age if they're selling and looking to inject cash flow into the plan in a future year. And then we can set that as joint and indicate whether the transaction is exposed to capital gain tax. I'll click next and go to the debts page to input their mortgage, which has a current balance of $180,000, interest rate of 5%, and monthly payments of $2,400. And that's joint. And we can set that to link to the real asset. Oops. Joint debt and link to the home. So this way, if we do sell the home at any point in the projection, it will automatically be used to repay the mortgage if there's an outstanding balance before using that money for any other purpose within the plan. I'll click next and go to the government benefits tab. Once again, we have control who's we're adjusting from the top left. So I'll start with John. We're going to begin CPP at retirement of age 65. And we're going to assume that John will receive roughly 80% of the maximum based off of his previous contributions into the CPP program. SNAP automatically adjusts the dollar amount. And if we wanted to defer this, we could also have SNAP automatically calculate the deferral benefit and adjust the ultimate amount of CPP that the client receives. Scrolling down, we can take a look at the OAS, which is defaulted to 100% of the maximum. So we'll leave that as is. Again, these values update in the new year, each year for the most current values. So if ever you're finding a case where the OAS that a client is receiving towards the end of a calendar year is not being accepted in the software, you can put it as 100%, and then first thing January of the next year, you'll be able to adjust those values based off of the most current financial information. Next, I'll click on Jane's name in the top left. We can scroll down, and in this case, we'll assume that she'll receive 85% based off of her employment income, having a few fewer years of dropout required. So she earned for a broader range of years that are being included in the calculation. If we scroll down, we can again see that the old age security is automatically being set up for 100%. I'll click next and go to the insurance policy section. We can input their existing term policies. So term 65. So John is insured currently until age 65 for a total death benefit of $250,000, and the annual premium is $400. And Jane is similarly covered until 65 for $300,000 with a premium of $350. Now on the left, we do have some additional pages available. We have the life needs analysis where you can calculate whether a client might require more insurance coverage. We can add RESPs, which in John and Jane's case is no longer applicable as those have been used up for their children. We could add a corporation if either of them had that, and then we can adjust additional settings as needed in order to customize each plan to our client's unique circumstances. But in this case, I'm going to click planning pages so that we can review all of the information that's been input so far and start to get a sense of how our clients are tracking and start to answer those 3 key questions that they came to us with. So on the planning page in the top left, we have the year and our client's age each year of the projection. For the period prior to the cash flow management start age, which defaults in all projections to the first year of retirement, in this period of the plan, we assume that all cash flow that is not being allocated to things like taxes, mortgage payments, or contributions to investments, anything left over is just going to be conservatively spent each year of the plan. So here we can see SNAP is automatically calculating the discretionary cash flow and assuming that that is all going towards expenses for the client. As we refine the planning page, this number will adjust. If we enter in additional contributions to investments, SNAP will calculate the remainder and assume that everything left over is getting spent each year. So let's go through the various planning pages to make those final adjustments. So if I click on John's name, that will take me to his personal planning page. I can see his income each year until retirement. I can see his taxable income, CPP, EI, taxes paid, his marginal and effective tax rates, and then we can see his various accounts and his contributions going into the work pension plan. So we'll make some additional contributions here. We'll enter in tax-free savings contributions of $7,000 a year until the last year before retirement, and then we'll enter in $5,000 a year to the RSP and copy that down until 64. And anytime that you make a change on the planning page, you'll see that the Run Scenario button turns red. This is just to prevent the software from constantly refreshing the numbers and rerunning the page. So the software will wait for you to confirm that you're finished with your changes, and then you can click Run Scenario, and that's going to rerun all of the numbers in the plan, and it's going to then turn green in order to confirm that that's now been finished. So now we have all of the updated numbers. We can see the TFSA and RSP contributions are being made, and we can also see that that has, as a result, reduced the discretionary cash flow that SNAP has calculated under the base expense value. Next, we can click on Jane's name to do the same contributions on her side. So we'll go to the tax-free savings account, enter in contributions of $7,000, copy that down until the last year of work. And then we'll go to the RSP and enter $18,000 a year, copying that down until age 64. Then we can click Run Scenario and get an updated projection based off of all of those inputs. So now if I go back to Combined, we can see that with their mortgage and investments and taxes all being paid, they're currently left with about $105,000 per year for lifestyle spending needs. This would be going towards things like groceries, transportation, property taxes, all of the recurring annual expenses that will likely continue throughout retirement. So this is a great reference point as you're developing your plans to determine what type of retirement income your clients might need once they do stop working. So we're going to take this 105,000 figure and input that as of the first year of retirement and copy that down until age 100. So if they wanted to assume that their current lifestyle that they're able to support off of both of their employment incomes, if we want to assume that that will continue throughout retirement and adjust over time for inflation, we can scroll down in retirement and see how long their money would last. So here we can see that as of age 84, they would have depleted the majority of their capital assets. So if we scroll back up a bit, we can see at age 65, the client starts withdrawing from their non-registered account. Then it starts using their tax-free savings. Then it starts using their RIF. And then eventually they deplete each of those accounts and are left just with the annual maximum coming out of their LIF asset. So as of age 84, we can see how much money they would have remaining, which is about 36,000 in the LIF, and then they would own their home as of that point in the plan. If we continue down to the very last year, we can see that the total shortfall that they would accumulate is about 2.4 million that they would have to borrow in order to continue spending at $105,000 per year. We can also review this plan through the charts. So if I click on charts in the top right, we can see the base expenses fairly consistent over time, about $105,000 a year, indexed for inflation. We have the income taxes payable throughout the plan, depending on the sources of income and how that's being structured. We have the mortgage payments, we have the insurance premiums, and we have the capital asset contributions to the TFSA and RSP. And if we look at the total inflow, this is where we can see that as of age 85, the amount that they have available as inflow is roughly half of what they need for their target cash flow. So that's where they would start to run into spending issues. If we scroll down to the cash inflows, we can take a look at where their money is coming from each year. So it starts off with employment income. Then they start receiving their government benefits of OAS and CPP. They have their LIF, RSP, TFSA, and non-reg. And then we can see there's this gap towards the end of the plan where they run out of supplemental income. Taking a look at the net worth, we can see here the large debt that builds up in the plan. And as of age 95, they would have used up all of the equity in the home. And at that point, they would be really out of options unless they had some other resource outside of the projection. We can also interact with any of these charts by clicking on the legend items. So here we can remove the real assets and just take a look at the liquid net worth and see that that runs out at roughly age 84. And with all of that information and understanding of the plan, we can now start to answer John and Jane's questions that they came to us with. So their first question was, how long will my money last? So if they wanted to continue spending at about $105,000 per year, their money would last until roughly age 84, at which point they would start to have cash flow issues and they need to scale back to about 50% of that spending goal. The next question that the client had for us is, how much can I spend so I won't run out of money? So if we take a look at the top right of Snap, we have a automated recommendation engine that you can use to help quickly answer these types of questions from your client. So if I click on recommendations, I can see the overall goal. So we have a target of retiring at 65 with $105,000 per year in today's dollar spending. They're currently off track or underfunded for that goal. In the final year, they're short by 2.5 million total. And we have options to be able to adjust the plan to achieve their target spending goal. So they might be able to work a bit longer, so we could adjust their retirement age. We could see how much more they need to save before retirement in order to achieve this goal, or we can calculate how much they would need to reduce their spending by in retirement in order to avoid running out of money. So let's do that first. So I'll click calculate. Snap will take a moment to run the various projections in order to determine that level of spending. And here we can see that rather than being able to provide $105,000 a year, their investment accounts and incomes would be able to sustain roughly $86,000 per year from the first year of retirement until age 100 of the plan. So I can click apply and run. And that's going to adjust the total amount available each year of the plan. Now it's still going to be inflation adjusted, and this value is after tax. So that's an important consideration to keep in mind. But in terms of the projection, this is how much they would be able to sustain. And then we can see as of the final year, they're left with zero in their capital assets and they still own their home. So the next question that the client had is, how much will be left for my children? So if they did change their spending goal and they wanted to go with this sustainable goal that leaves their capital assets at zero, we can take a look at the final estate as of age 100 and review what would be left over for any beneficiaries. So we have capital assets of 1.7 thousand, so that's mostly used up. We have real assets, the home of 1.5 million, no taxes payable. And so we can see that their future after-tax estate would be about 1.5 million, which adjusted for inflation in the equivalent purchasing power of today, 2024, that would be worth about 663,000. So that can be helpful to give them a sense of what sort of benefits their beneficiaries would be able to realize in that future year. If we made some adjustments to the plan, let's say that they wanted to leave a little bit larger buffer, we could change their spending goal to $80,000 and copy that down to age 100. Now, in this case, if they go to the final year of the plan, we can see that there would be about 800,000 left in capital assets, 1.5 million from the home. And so there would be about $1 million worth of estate today, or 2.3 in that future year with inflation factored in. So those are the three primary questions that the client came to us with. We do have about 5 minutes left in today's session for any questions. So if any questions or use cases came to mind that you'd like to see modeled, please, again, feel free to submit that through the GoToWebinar question box. I'll just comment on a few other pieces of functionality in Snap that might be useful for you. So the first is going to be related to the other recommendations that are available. So if we go back to that 105,000 a year spending goal, we can copy that down all the way to retirement. And then we could go to the recommendations and try some of the other calculations. So again, we're short by 2.5 million. If we click calculate on retirement age, we'll be able to see how much longer John and Jane would need to work in order to continue saving at their current rate and then eventually retire with that full 105,000 spending ability. So if they worked until age 69, they'd be able to achieve that target goal of maintaining their lifestyle all the way throughout the projection. So here we have age 69. If we wanted, we could apply and run in order to replace our current retirement age of 65, and SNAP would make all of the adjustments to things like the expenses, contributions, the DBPP if applicable. So there's a lot of automation already built in to make this as quick as possible for you. If you wanted to have a second plan, one where they retire at 65, which is our current projection, and one where they retire at 69, you could click copy scenario before applying recommendations, and that's just going to give you a second plan that you can reference and compare the two options in your discussions with your client. The other option would be to calculate the required savings. Now, the closer a client is to retirement, the less of an option this becomes, because they're going to need to save significant amounts in order to make up this fairly sizable shortfall. So in this case, they would need to save an additional $86,000 per year, which in total, with all of their existing contributions to the RSPs, TFSAs, and so forth, would bring them to about $130,000 per year of total savings that they would be making. So we could combine the two together. Maybe they want to save an extra $20,000 a year and work until age 68, for instance. Whatever is most appropriate for the client in order to balance their preferences and help them to best achieve their goals. Another option with the real asset in the plan is that we could use part or all of that equity in the projection to finance some of the spending. So if we go to assets, and then down to the real asset section where the home is listed, we could choose to sell that at a future age. Maybe they'd want to downsize as of age 75, so we could sell the property then. If we go to the planning pages, we can scroll all the way to the right-hand side, take a look at the real asset and the value over time. Now this is half of the value because we're currently looking at John's personal planning page. So it's giving him half and Jane half. So it would be sold for about $900,000 total, or $450,000 each. And then SNAP would just automatically allocate that cash flow into the capital assets and use it for ongoing spending. If they wanted to purchase a new home, so if they're selling theirs for $900,000, we could come here and purchase a new home for something like $700,000, so that they're able to realize $200,000 in new investments. So enter in a future purchase, 75, 700,000. And now when we come back to the planning page for John, so we want that to be a joint asset. So coming back, joint, yes. So that way they're going to split the cost in addition to receiving half of the proceeds each. So now scrolling down for John, we can see they're selling their old home for 900, purchasing a new one for 700, and then the net difference, less sum used for spending for the year, is deposited to the tax-free savings automatically. So if we take a look now at the combined, we can scroll down and see that that's going to extend their projection by a few years. Now, instead of running out at age 84, they're running out at 88. Another option that they have is to do tiered spending. So instead of spending 105 all the way throughout the projection, maybe they're comfortable reducing that target once they turn 75 to something like $80,000 per year. So if we change it at age 75 down to 80 and copy that to the end of the projection. Now, if we scroll down, we can see that there's no shortfalls, and they're left with roughly $250,000 in their capital assets as of the final year, in addition to owning their downsized home. So those are some of the options available when you're planning for clients approaching retirement. We've been able to answer their three main questions related to: how long will my money last? How much can I spend so I won't run out? And how much will be left for my children or beneficiaries? Really appreciate everyone joining us today. If you do have any questions after the session, please feel free to reach out to us directly. Our email is support@snapprojections.com, and you can find our toll-free telephone number by clicking on Help in the top right, going to Help Center, and then right here in the top left. You can also send us an email directly by clicking on Contact, or you can find all of our previous webinar recordings and articles throughout the Help site. Once again, thanks so much for joining, and have a great day.